Hey guys, Brad Bob here, and I want to talk today about a question that was recently asked of me from a FERS employee, and that is, what do I need to do today to avoid getting crushed by Uncle Sam or avoid getting crushed by taxes in the future? Okay, this is a great question and something I would recommend everybody think about and consider. So, number one, the earlier you plan for this, the better. Okay, starting today, you can't go back in the future, but starting today is going to help you in the future, whether you retire 2 years from now, 10 years from now, 20 years from now. All right. So let's get into it. And what do we need to do to avoid getting crushed by taxes? And the best thing that you can do, in my opinion, is to invest money in different types of accounts. All right. So you have three basic types of accounts for investments. You've got tax deferred, you've got taxable, and tax free. So tax deferred is like your traditional TSP or traditional IRA. You put money into that account, you didn't pay taxes on it, it grows tax deferred, you take money out, 100% taxable income. Okay? Very simple. Then you've got taxable accounts, okay? Taxable accounts are you have something like a brokerage account at a custodian. I'm going to use Schwab for example because that's who I use for my custodian. I have a brokerage account at Schwab. As that account grows, I invest in mutual funds, stocks there. As that account grows, I may have some taxes to pay on the gains there. And there's rules for different types of investments, but long-term gains are something that come into play there. Where if you hold a stock or a fund for a 12-month time period, then gains on that fund can be long-term capital gains. And tax rates for long-term capital gains are 0%, 15%, or 20% based on what your income tax bracket is, okay? So taxed very differently than what tax deferred money is. And then you have tax-free money. Tax-free money is like your Roth IRA, Roth TSP. We could even talk about health savings accounts, HSAs, and throw those in there. They can possibly come out income tax-free, but we'll simplify it and talk about Roth assets for today. So if you want to avoid getting crushed by taxes in retirement, invest money into all three types of accounts here, okay? The more flexibility you have with this in retirement, the better off you're going to be. All right? And what do I mean by flexibility, or what do I really mean by that? And the easiest example I can give is that I've had clients before on the edge of the 24% income tax bracket, meaning they went all the way up to the 24% income tax bracket. And then if they took more money out of a tax deferred account, like TSP or an IRA, then that was going to put them up into the 32% income tax bracket. So they're going to lose an additional 8% off the top, okay? So to avoid doing that, what they could do is they could take additional funds out of their Roth accounts, okay? Roth IRA, and then that money comes out income tax free and they avoid paying that 32%, all right? Where do Roth distributions go on an income tax bracket? They don't. There's no spot for Roth distributions on, did I say it? Where do they go on a tax return? There's nowhere for them to go, okay? Because it's income tax free. Therefore, they don't go anywhere on an income tax return, all right? So you may have heard people talk about manufacturing your own tax rate in retirement. I probably even used it. And what I prefer to say is you want your income to be flexible. You want to have the flexibility of having different accounts in retirement to draw from that are all taxed differently. And what that will do for you in retirement is it will give you some control over your income tax bracket and how much you pay in taxes, all right? So again, plan for this today, all right? The sooner you start planning for this, the better. Everybody's situation is a little different, okay? So it's going to depend on if these three types of accounts are a good fit for you today, okay? So figure that out. Um, like I said, this isn't advice for everybody. This is just general financial stuff here that we're talking about. Do some analysis on your own or talk to somebody that knows what they're doing to figure out what the best fit is for you. And if you need more information on this, I'm going to put some links to a couple of articles or videos down below. I've talked about this a bunch in the past. Good information to know. Please take some time to learn about it. Thanks, guys.